Welcome to our comprehensive guide on using investment policy to shape your financial future. This video will walk you through the development of an effective investment policy using real-world examples, questions, and data analysis. An investment policy is essentially a roadmap that lays out an investor's objectives, risk tolerance, time horizon, and other pertinent factors. It acts as a decision-making framework that helps to ensure your investments are aligned with your goals. Why is an investment policy crucial? Without a clear policy, investors often make emotional decisions, react to short-term market fluctuations, and risk deviating from their long-term objectives. Let's look at some data to understand its impact. Developing an investment policy statement, IPS, involves several key components. The first component is setting your investment goals. This includes both financial objectives and timelines. For example, a 35-year-old aiming to retire at 65 might have a primary goal of accumulating $1 million in retirement savings over the next 30 years. In contrast, a 22-year-old saving to buy a home might set a goal of saving $50,000 within 5 years. Next up is risk tolerance. This is your willingness and ability to endure declines in the value of your investments. Evaluating your risk tolerance helps you to structure your investment portfolio accordingly. Here's a question to consider. What is your reaction if your investment portfolio loses 10% of its value in a short period? Your answer can help determine your risk tolerance. Different portfolios have different levels of risk. For instance, a conservative portfolio might be composed of 70% bonds and 30% stocks, while an aggressive portfolio could be 20% bonds and 80% stocks. The next component is asset allocation, which is the process of dividing your investment portfolio among different asset categories such as stocks, bonds, and cash. Asset allocation significantly affects both the risk and return of your investment portfolio. Consider the historical performance of different asset classes over the last 10 years. Diversification means spreading your investments to reduce exposure to any single asset or risk. The main aim is to maximize returns by investing in different areas that would each react differently to the same event. For example, let's say you have a portfolio containing tech stocks, pharmaceutical stocks, and real estate. If tech stocks decline, gains in the other sectors can help cushion the impact. Now, let's talk about rebalancing your portfolio, which involves realigning the proportions of assets in your portfolio as needed. This ensures that your portfolio reflects your evolving risk tolerance and financial goals. For instance, after a strong performance by one asset class, your portfolio might become overweight in that class. Rebalancing would involve selling a portion of that asset and buying others to maintain a balanced allocation. Here comes a critical question. How often should you rebalance your portfolio? The answer varies, but commonly, rebalancing is done annually or when an allocation deviates by a set percentage. Lastly, let's address tax considerations and costs. Taxes can significantly impact your returns, and it's essential to implement strategies like tax loss harvesting to enhance after-tax returns. For example, if you have a capital gain of $10,000 from selling an asset, and you sell another asset at a $3,000 loss, the loss can offset the gain, reducing your taxable gain to $7,000. With a keen understanding of these elements, let's go through a question to sum it all up. What are your investment goals, and how do they align with your risk tolerance, asset allocation, and tax considerations? Remember, there's no one-size-fits-all solution when it comes to investment policies. Tailoring your policy to your unique situation is vital for long-term success. Review your investment policy periodically to ensure it still aligns with your goals and market conditions. Thank you for joining us on this deep dive into investment policy. Don't forget to like, subscribe, and share if you found this video helpful. Stay tuned for more insightful financial tutorials.